QuickBooks Pro Desktop 2021. Forward contract for speculation that foreign currency will strengthen maturity date transaction with the help and use of Excel. Let's get into it with Intuit. QuickBooks Pro Desktop 2021. Here we are in our problem 2, multiple currencies practice problem. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. In prior presentations, we put the forward exchange contract on the books and an adjusting entry at the end of the period to adjust it for financial statement purposes. Let's take a look at it, looking at the balance sheet, going from the reports dropdown, company and financial, taking a look at the balance sheet standard. Balance sheet standard, changing the dates in the customized reports from 01/01/21 to 12/31/21, and then OK. We have on the books the accounts receivable. Double clicking on this item, we put the forward contract on the books using the forward rate, or the rate, the speculative rate as of that point in time. Then we made an adjustment for it for the year-end purposes for our adjusting entries to make the accounts receivable correct as of the cutoff date, December 31st, year-end. Closing this back out. No adjustment happened down here to the payable account because that will remain the same as we will be paying it in dollars. Now we're going to be saying that what happens when this thing terminates. To do that, I'm going to go over to Excel first. We will consider it in Excel first, and then we'll go back to thinking about how to record it in QuickBooks. In year 1, this is all the activity we had for our contract. We put it on the books, the receivable on the books, we have the payable on the books, and then we made an adjustment to the receivable as of the end of the year. This is going to be our year 1 trial balance. Note the only difference between this and on our QuickBooks file is we had the $100,000 in cash that we put in the retained earnings, which we should put into the QuickBooks file just to tie in so that we have the cash there. But we're focusing in, of course, on the forward exchange contract here, and then the gain that was resulting. Now I'm going to take these ending balances, bring them over to the beginning balances for year 2 now. So the beginning balances are all the same for the balance sheet accounts until you get to retained earnings. Nothing's on the income statement because we simply took the ending balances here, combined them to one number, basically closing out the income to the equity, and that's what we're starting at the retained earnings. Therefore, we can see what should be allocated to the temporary accounts to income in the current time period. All right, so now we're going to say, okay, what happens when this thing ends now? So we had our cutoff date, and now let's end it with journal entries and think about what the journal entries will be. So now we're going to say that it's the end date 120 days later, which is 3/31. So we started with a 120-day contract. Now it's the end of the contract. We're going to complete this full process. Now we're going to use the spot rate instead of the forward rate. Why? Because there is no forward rate. The forward rate was always speculating towards this point in time. Now we're at this point in time, so there's no more speculation, and we can use then the standard or the spot rate, which would be the exchange rate for the current time period. So to do this, we gotta first adjust our receivable again. So we'll think about adjusting the receivable based on the new rate, which is going to be that 0.602, which will actually be the spot rate at this point. So if I pull out the trusty calculator then, we're going to be taking the 100,000 that we're going to be receiving, 100,000 in foreign currency, Australian dollars, times the current spot rate, 0.602. That means we're going to be getting the 60,200. And we started at, or after the last transaction, we were at the 60,900. We were at the 61,200. So this is going to be a decrease. So we're going to have a decrease resulting here. Does that make sense? Well, let's compare this. Last time, $1 Australian dollar would have gotten us 0.612 US dollars. Now $1 Australian dollar is only getting us 0.602 US dollars at the current point when this thing expires. And that means that the Australian dollar has gotten weaker because you can get less US dollars for it than had been the case, or what we were speculating to be the case in the past. So the Australian dollar got weaker. We're going to get paid 100,000 Australian dollars, and now the purchasing power is less than it was when we speculated and made the contract, or at least less than the last time we looked at it, and less than the contract. So we're going to have a loss here. So that's not good. It's bad speculation now. We thought it was looking good last time, but we have a downturn. But in any case, that's going to be the transaction. Now, if I subtract this to what is currently in there, so what's currently in there is that 60. So this is going to be minus the 61,200. we have a change of 1,000 then. So 1,000 decrease. So let's go ahead and record that. On year 2, we're going to say that the receivable is going down. Receivable is going down. And then the other side is going to be a loss. Now we have the loss recorded in the current period. So we had a gain last time, loss this time. And so this is going to be then equal to, I'm going to calculate this with brackets. I'm going to subtract the two rates that are involved, the larger rate first, so it'll turn out to be a positive number. So this is where we were at last time minus, this is where we're at this time. I'm going to close the brackets, multiply times the 100,000. There's once again our $1,000 change. So that's going to be the debit and the credit. So the debit and the credit then. Let's post this out. So if we post this out, we've got a loss down below. So the income statement now is representing a loss in year 2. So loss in year 2 for the 1,000. And then we have the foreign currency is going to be equal to the 1,000 credit. That brings us to the 60,200, which should be once again equal to the 100,000 in foreign currency times the current spot rate now, 0.602, the 60,002. Now the next thing that's going to happen is the easy part of this transaction is to pay off the item that isn't in foreign currency. So this item down here is not in foreign currency. We said that we were going to pay off the 60,900. It didn't change. That's not where the speculation was. The speculation was on the receivable side of things. So we're going to just pay this one off with dollars and nothing really unusual taking place there. We're going to decrease the dollars, pay off the payable. So I'm going to say, all right, that one is pretty straightforward. I'm going to say the payable needs to go down to 0. We're going to pay that off because 120 days have now passed. And we're going to pay it off with dollars. And we're going to pay it off for the original amount that was in there. So this has remained the same through the whole time period of the 60,900. That's what we originally put it on the books for. And the dollar amount didn't change. That's not the speculation. That's not where the speculation is at. So then we have that. Let's go ahead and post that out. So I'm going to say, all right, cash is going to go down then with the credit of the 60,900. And this item is going to go down with the debit down to 0. So there is that. And then on the receivable side of things, we're going to be receiving, and we're actually going to be getting now the foreign currency, the 100,000 units, but we're going to value them in US dollars using the current spot rate, which is going to be the 0.602. So we're going to say, all right, so now we're going to get money. We're going to get money. It's going to be like a checking account, but it's in foreign currency units, which we can think of as basically an investment, kind of like if we had stocks that we would measure the value of them using dollars. So I'm going to say that. And then the other side is going to be decreasing the receivable. Now we've already valued the receivable to the current exchange rate, the 60.2, the 60,200, which we can calculate over here again, which is simply going to be equal to the 100,000 foreign units, Australian dollars, we're actually going to get, times the current rate, which is today's spot rate. There's no speculation here because this is today's spot rate. So we're taking up today's rate, and there it is, and that's going to be the debit and credit. So now we would increase the asset then of the foreign currency units. 60,200 represent the current US value using the current spot rate of the actual units that we got, which are 100,000 Australian units. So we're holding on to 100,000 Australian units, Australian dollars, which we're valuing at 60,200 using the current rate, the current spot rate. All right, so then the other side is going to be here. There's something in it, so I'm going to double click on it and say plus, and then we're going to pick up the that item. All right, and that brings it back down to 0. So at this point in time, then now we're done with it. We've got our foreign currency units, and what was the result of this? And our speculation, it actually turned out to be a bad speculation. It was looking good before, but then we had a loss last time, and we had a gain this time. So the net was a $700 loss on the speculation. So didn't turn out the way we wanted. We should have speculated for like 30 days or something instead of, but whatever. So we ended up with a loss over the full time period. Now, when we put this into the QuickBooks system, if I go back to QuickBooks, and we'll do this next time, but let's just think about it now. If I go back to the home page, we entered the receivable side as an invoice. Then we had this interim transaction that we entered as of the end of the period to do the adjusting entry. And then typically we have the receive payment. So we're going to receive payment in foreign currency. This item is still pretty much the same, that we can receive the payment, but usually when we receive the payment, QuickBooks will record the adjustment, the gain or loss for us between these two dates. So if we just had these two dates, then we can use this process and QuickBooks would record the gain or loss. Because we enter the adjusting entry in the middle, then we're going to have to do a reversing entry before we hit the receive payment. Or if we don't do that, it will double up that transaction. It'll double it up. And then also, if I go back on over here, this transaction, this second transaction, we don't really need this one in QuickBooks, because what QuickBooks will do is record the difference between the transaction on the first date and then the last date for the receivable. And so all we need to do is make sure that difference, which will be 700 total, right? It's going to be the 700 between the two rates, the 1,000 minus the 300. We need to allocate the proper portion, 300 to the prior period and 1,000 to the current period, for the gain in the prior period, 300 loss in the current period. And so we got to allocate that out, and we'll do that by doing an adjusting entry and then a reversing entry. So we'll do an adjusting entry for the period in adjustment. We'll reverse it in the current period, resulting in the current period having a loss of 300 that will then net out against the total loss, which will be 700, to get us to that 1,000. So we'll see how that plays out. So we're not going to enter this transaction as a journal entry into QuickBooks. We'll basically do a reversing entry for this transaction, and then we'll record the recording of the receive payment, which will basically record the difference. The receive payment transaction then will record the receipt of the payment, increasing the foreign currency units here. It will decrease the receivable account, and it'll account for the difference, the change that will be in the foreign currency transactions down below. So we'll continue on with that in QuickBooks and see how those steps can kind of be put together, resulting in the same ending result.